Hey everybody, it's the Market Sniper. Let's bring the audio a little closer, make sure you can hear me. How's everybody doing? Glad to be with you. Nice. Want to talk to you about your next financial crisis. I think it might even have a name. I think we might even know what its name is and how and why it's going to be a super surger for gold. We'll take a look at gold. Everybody a little bit concerned, not concerned at all here. Not concerned. This game has barely begun. You were going up kind of quick, natural correction. We'll take a look at that and the charts. How HVF method will allow you to stack ever more gold ounces. That's right, how it will do it and how we'll be helping you to achieve that in an accelerated fashion in this general large mega bull market. And we're going to talk to you about that Cayman Island basis trade. It's not only in the Cayman Island that it happens, but it was part and parcel. So to do all this, and thank you for your comments and your engagement here. We see you. Hello, hello, hello. That's what they say. In fact, let's read a few. I need different glasses to read. Ooh. These are not so good looking. But anyway, they'll have to do. I can read. They're the cheap ones that you buy in the store because I'm too lazy to go get my eyes checked. Let's have a look. Hi, world. England calling. Lots from England today. Glad to see the English in the house. Big problems in the United Kingdom. Time to check out. Go somewhere else. Go where you're treated better. A whole bunch better. We get a whole bunch more freedom. Start by being in the community. We've got a number of people from England. Some have bought in the beautiful Cape. That's right, and are living their time out there for part of the time. They're disposing of their bullion, they're getting help and support in the community. Go to themarketsniper.com, book a call. Don't forget to do that. You can engage with us a whole bunch further and our onboarding team and find out what it's all about. It costs nothing and there's no obligation. It's a community of the willing. HVF method will accelerate your stack. Ooh. Visited my local place of hide for bullion and just get a few token pieces, by the way, before we get into the big Cayman Basis Trade BS Ponzi-onomics. Just look at that. Isn't that beautiful? This is beautiful stuff. This metal's right here. This will become, for the everyday man, virtually unobtainium. And I love it. That's a Scottsdale mint version silver. Ooh, and for those of you that have been to the gym a little bit more and like heavier weights to push. Yeah. Oh, is that lovely? Oh, it's quite heavy. It's heavy. Oh, it's heavy for me aging hands. In God we trust, it says. 999 troy ounces. Bit of delt work. Must do your delt work, your morning exercise. That's right. A little bit of bicep work with the lighter weight. There we go. Beautiful. You should be stacking, and you could be stacking safely and vaulting in a place outside of American jurisdiction when we get, no doubt, all forms of nefarious. So here's a few things people need to be reminded of. So when the debt and fiat-based system is collapsing, and I want to actually clarify also debt and fiat, a lot of people seem to think they're totally separate things, and that's a voodoo trick. It's a clever banking voodoo trick. And I love it, and I have to give some credit to Chris McIntosh, who was on our channel recently. And I mean, he just put it so super beautifully. Here's what Chris said. Chris said, it's all fiat. It's all fiat. Debt is just postponed fiat for delivery at a later date. That's all it is. It's a contract for postponed fiat for which there's a carry cost charge or a premium. That's the usury or usury. Everyone gets upset when I say usury. Many people say usury. Some people say usury. It's all good. But that is the Pharisees. The Pharisees of extracting. Thank you for your 38 likes so far. The other 220 are disgusted. We're going to be talking about the great Ponzi-onomics and the great reveal. There was something that happened in April. So we're going to show you that on the chart before we dig into the weeds. Here's what happened in April. We must go show the chart. Did I do it? I'm so bad, I probably didn't. There we go. Let's go back and say share entire screen. So here's the share entire screen. Let's go, tunneling, we go. This was gold. Now, April, round about April, we had said from 2000 that it was once, twice, three times a lady, and that the fourth time you would break and run, and that the targets would be $2,900 to $3,000. And in actual fact, you met that target over here. Here's you making that target right about there. Beautiful. That was just through the 3,000. You're at about 3,100 something. Then you had your predicted sell-off. It was a 6.7% sell-off. total typical price progress decay after making a target. Bear that in mind, by the way, with our current pullback. I'll be updating the percentage for you when we do the technical bit in a minute. But we are talking about the basis trade and why it's all about gold. It comes back to gold. It sounds technical, it sounds Ponzi-onomics, repo markets, money markets, It goes all the way back to gold because it had its big wobble. It had its big wobble in April during Trump tariff tension. And what was really interesting is that all your dollar and debt maximalists, you know, the same guys that post all the time, oh yes, steady demand for treasuries, another great auction held, lots of offshore money ready to invest in the dollar debt system. You know, those guys, you know who they are. Well, we're coming back to them in a minute. But during that time in April, what actually happened is gold ripped from around about the low here. We'll give you after its progress decay for making the 3K, the natural pullback. It ripped a 18.39% to $3,500. So it was in and around the lows. Let's remind you, all of us, low, where's the numbers go? Let's get that numbers back, please, thank you. The low was 2956, and then boom, straight up to 3,500. And at the same time, what's important to remember is US 10 years, yes, it comes to treasuries. The fate of your future is determined by how much you are out and short of the one and in and long of the other. That is it. The polarizing event of your wealth and your future and your children and everybody else and the quality of your life is determined by how much are you exposed to the US debt system as your assets class well bid in the auction, yay, or how much you're actually long and holding of gold. And this is what happened on the exact same April date. There's the April, as you can see it. This is the rate on the 10-year, that's right. It determines your mortgage costs in America. The 10-year is the typical tool for determining mortgage costs. And all the subsequent terrible non-farms and then the non-getting any non-farms, course, close down. Don't forget, we're in close down right now. So the not getting any non-farms and the bad ones before it, the recessions, the talk, the pressure on power from Trump, the whole turn it down, the shocking numbers, the layoffs in Amazon, the new thing. It's not all going on AI jobs, it's just layoffs because of a weak economy, and Amazon's still 52% an online retail store. All the other stuff and the status stuff is 48% of the business. So, you know, you're not buying on Amazon, oil price is low, all that stuff that we said is a recession. It's kind of a recession, isn't it? Oil price doesn't do that. If everybody is buying stuff on Amazon, taking delivery, moving, family, travel, holidays, No. Oil price doesn't do that, friends. Anyway, so you've been giving up ground all this time and more admittance to the fact that you're in a recession and all these down legs, you're yet to meet the low just before the basis trade wobble pump. Just before the basis trade wobble pump that went up to there. You haven't made it all the way back on what spiked in literally days. 1 day, 2 days, 3 days, 4 days of upside move. And what was ironic at the time, friends, is that Donald Trump made the statement to journalists, I wasn't worried about the US bond market. Why was he even commenting on the US bond market? Since when is he someone who's even giving opinions on asset classes? He doesn't say, I wasn't worried about the NASDAQ selling off. He doesn't say, I wasn't worried about the price of gold. He doesn't say anything about it. Now he's talking about he wasn't worried. He wasn't worried. Inversion perversion rules, the Tony B. Liar indicator that says invert the politician. They were worried about the bond market. But anyway, we'll come back to that in a minute. So that's what actually happened on rates, that spike. And you have still not, from April, all the way back then in April, come all the way back to the place that you were actually going when we were already starting to realize that, you know, the markets were quite weak, there was a bit of a recession, and we were selling off there. So you haven't unwound that basis trade wobble that was peak Trump tariff tantrum. And we called it that. We gave it the name. That was Pete. It was the first time he came out and said real loud and aggressively how he's going to do 100% on just about everyone. Of course, China being one of the most important as a result of the trade deficit and everything else that was going down. That was April. We pumped to 3,500 on gold, and then we went into a continuation pattern that lasted an extended period from April until clearly September. And we said eventually, we were early once, but we got it right the second time. You're now going 3.5, and you will continue to pump and break out to the upside, which ended up happening. And we literally put on $1,000 in a fraction of the amount of time the previous 1,000 took and the 1,000 before that. I'll be coming back to that as well, how quick the thousands are coming in. But before we leave the April events, I also want to show you what happened on the currency. You see, still on the daily, look at all my funny, weird lines. They're right there where April was, and you went into a peak crash that had already begun to see the Dixie sell-off. But the April, so you had rates go up. You had rates go up, friends, and you had dollar go down. And we continue to highlight this. This, now we're learning in retrospect. Why are we learning in retrospect? Because the Bank of International Settlements has been saying a few things recently. Other people have been noticing this, and we're going to cover some of the text on that. And what has been happening is the Fed suddenly was forced to restate how much the Cayman Islands holds of treasury debt. And it went up 4x, an already whale, a massive whale, for its size particularly. By the way, that's the Cayman Islands. You could be getting our Substack just by registering for our mini-series. Hit the link in the YouTube below. You'll get our mini-series, a series of videos that will give you the top line, headline, aspects and benefits of HBF method. And the only thing you'll receive is our newsletter, which goes out at maximum twice a month, and is short reads. This is a 7.1 billion GDP island nation in 2023's numbers. 7.1. Let's say it's 7.5 today. I mean, the dollar is diminishing, isn't it? Let's say it's 7.5 today. They hold 1.8 trillion on restated on the Cayman Islands statistics. 1.8 trillion. So that is the equivalent, 257 times, by the way, that is the equivalent of you watching this video right now, one of you on 250 grand. Somebody's there who's getting a gross salary of 250 grand. Let's pretend GDP is the salary of the nation. It's a bad number. It's got a lot of consumption garbage. Doesn't mean anything, especially if you're consuming on debt, because it's, you don't own that money and you're spending it. But anyway, let's just say it's your gross income, GDP, 250,000. What does it actually do? Your bond portfolio would need to be $68 million. Let me just say that again. So you're on $250,000 a year, 250,000. That's not your net. You got a mortgage, you got a car to pay, you got kids, and you got everything to pay. But your bond portfolio is 68 million. How many 250 granders mates have you got that have a 68 million bond portfolio? Well, the Cayman Islands has. But here's the thing. They don't even own it. They are borrowing. So let's go into the weeds and understand the basis trade to find out why the current new combination of subprime and long-term capital management crises are currently being brewed up by yours truly in the name of creating a buyer of last resort that will continue to consume. And let's talk about issuance of treasuries right now. The current rate of treasury. You were 38 trillion 2 months ago. You were 37 trillion, apologies, 2 months ago. Today you're 38 trillion. Today you're 38 trillion. That is, I mean, in 2 months you put on another trillion. Now we're sitting here in October. It's the end of October. November, December, you're probably 39 trillion, but hey, a little crisis or two, we could be knocking on the door of 40 trillion very early in the new year. Your New Year's gift, your party, will be the $40 trillion party. I'm suggesting very, very close, if not. So that's the rate of debt. So let's talk, and I want you to pay some respects to someone else who's been doing some great work, who I've also just jumped onto this theme, and I saw his work, and it's amazingly good thread that he's created that has jumped on this. So watch it. His name's Jeffrey Falvery. I'm not sure I pronounced that right, but he's on Graph Paul. Besant, the hedge fund farmer. This is fascinating. I want to take you into how the fact that the Fed will be forced to backstop the degeneracy of the repo markets and the hedge fund industry. And we'll talk also about negative haircuts on UST as major systemic risk, as specified by the BIS, the Bank of International Settlements. So what's happened that's made the April events interesting is that the Bank of International Settlements has started to make a few noises, and they're talking about America. Also follow Joseph Wang, who's done some great work in the same space. So here's the interesting thing. The US government is spending $2 trillion more than it collects. I would argue that's going to be a lot higher per year because they're generating new borrowings of $1 trillion every 2 months. So that's $6 trillion a year. I don't know if income tax are going to keep holding at the $4 trillion mark in terms of that annually. And as all parabolas, they are going up. In fact, the last month, the last 30 days was 550 billion, which is actually more than half of the original trillion. So actually what you got is you're trying to catch a parabola. But anyway, ignore that for a while. I think it's a lot worse. Who buys, this is the $1 million question. Who buys all the treasuries? Who is buying a terrible asset, basically? A bad asset. Don't forget, it lost 55%, pays you very minimal yield. So it's like a bank deposit. But occasionally, hey, you might just lose 50% of your money and get a haircut from the bank. That's what actually Treasury. They never used to be that. During the 40 years of the financialization of everything, they never would lose 55% in a short time frame because rates got put super low. There was a whole clear out done by Volcker in 1980. Gold had run really strong, and they refinancialized and reset the clock. And now we've had 40 years of bingeonomics under Greenspan, the economic criminal against most of the working world that should end up in some financial Hague for crimes against humanity of a fiscal and economic nature. But let's park all that, load up, Bernanke, Shlomo, Granny, Yoda, Yellen, into our friend Jay and everybody else who's been left to pick up the puke party. Who buys all the treasuries? A huge chunk is being bought by hedge funds, quite a few of which in that CIA island called the Cayman Island, where ex-Goldman Sachs bankers go to retire, run hedge funds, play golf. And yeah, that's where they hang. And as I've already shown you geographically, an absolute speck of an island over there. That's right. This is one of the biggest support buyers of US treasuries right here, right there. And if you don't think that's odd, that Mr. 250 grander with his 68 million portfolio of your stock, then, I've also got bridges to sell you all over the world. But anyway, so what they're doing is they're letting people control $100 of treasuries with only $5 to $10 of their own capital. This is known as leverage. In some instances, that's going right up 50x to even 100x. And what are they doing? What is the basis trade? They're actually long the treasury. They're buying it. So when they're issuing this new money, all the strong, firm demand for treasuries is coming from a hedge fund that doesn't have the money. He has $5 of every $100 he needs, or in some cases, $1 or $2. Yes, it's that bad. We'll get into that. They then short the corresponding treasury future. So for those of you who like a little bit of technical news, futures trade higher when the delivery is further out. So gold today, for example's price will be further out the further you go out because of the fact that you're saving on not having to store it. If you don't buy it now, you only get it when you actually need it. Let's say you're a jeweler. Of course, the inflation and devaluation, interest, other things that you're saving. Typically, and this is referred to in futures market as contango. You should have a market that is heading upwards the further out you go by price for later delivery. for all the money you're saving, not having to store or have it too soon and getting it just in time for when you need it. And even futures do that. Sometimes, most times, but not, as I'll highlight later, every single time. So what they do is they sell the future that is worth a bit more. And then as the clock runs down and you get to the delivery and expiry date of the future comes off or the spot moves. At some point they meet. And it's not to say the future might come off a lot and the underlying value stay the same most of the time. Sometimes the underlying value might go up and the future stays broadly the same. But they meet typically in most instances in normal markets. It's called contango, sorry. The crisis is when you get backwardization, which is the opposite. And that is always an interesting, and it highlights stress in a market. So what they do is they get that small, it's actually not very profitable, but what they do to fix it is they leverage like gangbusters. So if you've only invested $1 or $2 or $10, and you're actually getting geared up 10x, a small return on the near-term future actually on the capital you brought to the market turns out a bit more worth your while. Anyway, so while they're doing this, trillions of dollars of these dollars in these trades exist. They are vast. So this is actually another version, and we will say, of Ponzi-onomics, and you'll see in a while why we say that. So the catch is this trade only works if repo funding is cheap, because those hedge funds don't pay for it. They get a loan. And where do they get loans from? The same people, the interbanking lending people, the repo markets. And they do it almost on a day-to-day basis. So you're getting day-long loans and paying a small smidge. And the next day, you're rolling that loan for another day. And you're paying the repo market intraday and daily rate each time. That comes out of your profit on the difference between the futures that you shorted up top here and the underlying you bought here, all expecting them to meet at some point over here where you will pocket that margin. That's what's going down. This is called the basis trade, and that's what you're getting. So that is some of the important detail. Let's go into some of it more. Every new treasury that is issued is potentially fuel for another leverage trade, which needs more repo financing. You see, the issuance that are having no problem with people wanting dollars and denominated assets is actually putting greater stress on the repo market because it's a Ponzi scheme and people are borrowing to buy those treasuries in the cash market to own it at spot so that they can short a future against it and get the overall slight difference in premium. The more deficits, the more treasury issuance is happening. You've got a guarantee of deficits because you've never lived inside of your means and you want a runaway parameter. In other words, the debt issuance is only going more. If the debt issuance is only going more, there's more treasury issuance and there will also be more leverage buying because those are the only people who are going to buy your assets because they've got a trade where they think they can get return. And with that becomes more demand on the repo market liquidity, which is the interbank lending markets. And that has a knock-on effects on the money markets and banks, and it is finite. It is finite. The lenders of repo cash do not have end of the world levels of money to lend. And as they run out of easy cash, e.g. the Fed's reverse repo facility, they demand higher rates to lend. And that can lead to stress, fear, and also upward pressure on rates generally for all leverage and bank items, which is why we've always biased longer in the end on the upside. We are in that continuation payment period on the bond markets, the US 10-year. As I just highlighted, that surge in the 10-year has taken all this time and has not yet retraced that single event that's transpired, and that in the longer run, bonds have to devalue and rates have to go up. That is, for us, one big continuation pattern. Have a look at it on a longer time frame. The others don't like looking at the longer time frame because it illustrates that the larger trend, let's show you that trend, has been a major reversal call, and that you are probably in some form of continuation pattern right here in terms of rates, and you're having regular wobbles. So if you have a proliferation that is extremely vast, it is quite clear that the leveraged buying is upholding the valuations of treasuries. But the people buying it are actually just passing that risk on to, because they're borrowing repo, and they're passing that risk on to the banks, the primary dealers in the bonds back, who are facilitating this no questions asked excessive leverage. Go and try again, 99% loans against your collateral if you're not supporting the Ponzi scheme of the debt system anywhere else, and you'll find much more intense auditing and underwriting criteria. Rest assured. But somehow this is leading to ever greater lending. And what becomes fascinating in all of this is that in actual fact, the lending is getting so great that they are even allowing greater loans than the value of the collateral, which is called a negative haircut. Typically, they should keep a certain minimum margin for adverse moves that the person putting on the trade is stumping up. But now they are talking of negative haircuts. So let's show you some interesting formulas out of this thread that Jeffrey put together. Even if the Fed flooded the system with reserves, as long as fiscal deficits keep growing and leverage demand keeps rising, that cash will all get absorbed. We are having a shortage, actually, of repo and money market liquidity. Don't forget, Buffett's on the other side of that. He's got over 300 billion in the money markets, earning around 4, a little bit more %, and is actually providing capital for hedge funds to do leveraged trading, buying bonds and treasuries. I love this. So the more bonds, let's show you this key formula. This is the key formula. If you want to understand this thread, you just need a graph, and it comes right here. It comes like this. More bonds issued, yes, unavoidable. The more leverage buying, yes, there's nobody else. China don't want to buy it no more. There's nobody who can buy on the volume. Let's be clear. 1 trillion every 2 months. There isn't a country, there isn't a lot of countries that you can put on a list that could continue to absorb that. Even, not the UK, not Europe, they can't buy a little bit each time. No one's buying 1 trillion every 2 months of your debt. It's too big. And I have to remind everybody what a trillion is. A million will take you 12 and a half days, counting 1 second a number. That's right. You start night, day, on the toilet, counting 12 and a half days, it'll take you to count 1 million. You want to count a billion, and that suddenly becomes 32 years, in excess of 32 years. To count to a billion, to count 1,000 1 millions will take you 32 years. How many of you have 32 years left of your life? I don't know. Who knows how many years left of a life? I would be happy to have another 32, I think. And I'm certainly not going to use it counting up to a billion every single second non-stop. And a trillion is 32,000 years. Imagine being obliged, your entire generation and all those born beyond you, how I'll have to commit to count to millions and billions the whole life. You would have to look through your sons, your daughters, your granddaughters, your great-granddaughters, your great-great-great-granddaughters, going back generations into the future for another 32,000 years of lineage to count to 1 trillion, friends. That is the scale of this Ponzi. A little Caribbean island almost has 2 of them, by the way. Let's explain the reason and what happened in April. So this is a little bit about the BIS. The BIS started asking questions and started putting out warnings. In fact, that's not the one with the BIS. Let's have a look with the BIS insert. It's not that one either. They started saying, hang on a minute, this has become a crowded trade. A safe trade, it's not that safe, it's not a great return, becomes the systemic trade because of negative haircuts. So let's deal with the negative haircuts. The BIS has indeed warned that in certain repo and collateral frameworks, especially in cleared derivatives and security financing transactions, the use of negative haircuts in recent years due to perceived safety and scarcity of high quality collateral. That sounds straight out of the George Gammon school. Oh, there's a shortage of high quality collateral. We need treasuries. There's not enough treasuries. It's like, mate, how many do you want? You know, I'm talking about the line of oil tankers with pink crops going all the way back to China in just non-stop oil tankers of pink crops. Oh, I'm lacking quality of pink rubber shoes to buy. You know, no, you aren't. In recent years, this is the whole fabrication about a debt-based proliferation system, that which is proliferated on such scale can be high quality and rare and of great value. It's none of those things. In recent years, due to perceived safety and scarcity of high quality collateral, I love that, I gotta love that. I mean, that is classic. Some systems effectively applied negative haircuts. What that means is you post $100 of UST and you get more than $100 in purchasing power. You see, they've created a fake sense of value. If you buy our utterly shit overvalued asset for which there is absolutely gazillions of, we'll allow you to borrow even more than that which you bought. So you have a house worth and valued at $500,000, I'll lend you $750,000 against it. Go buy another one and you can get another $750,000. You've just conjured up 300 grand of cash flow, not quite cash flow, but capital to go do whatever the hell you want with it. Isn't that fascinating? A negative haircut. What it means is you're getting an overextension of valuation. This on an asset, pristine quality, lost 55%. How do you call something of scarcity and pristine quality? Scarcity, $1 trillion. Remember that number that I've just committed your entire generational lineage for 32,000 years for? That number, that's just one of them, by the way. 1 trillion. And it's scarcity. Yes. Oh, very scarce indeed. Very, very scarce. Pristine quality. 55% collapse since our turn. Listen to the lies and the absolute garbage. It's like everything that government shits is gold. Can you get your head around this absolute mind warp that they put on repeater stations that government just pristine quality, gilt, gold edged, copper bottom, you name it. They'll use mindfuck ningery to absolute throw out adjectives that has everyone going, oh yes, it comes from the government. It's amazing. It is absolute garbage, over-proliferated, overpriced, capital spilling, 55% stomach guts spilt on the floor, cracked its pants. It is absolute garbage, and it goes down. Get this absolute language that is so programmed and such a deceptive lie and so well repeated through all Bloomberg, all mainstream media, all the pristine. Let me tell you, there isn't anything pristine about any of that. Anyway, this amplifies leverage and encourages crowding into the risk-free asset. Risk-free. Now, there's another word that has to be slaughtered on the sacrificial bullshit altar. Risk-free. There is absolutely nothing risk-free about the hyper-valuation. The only bubble, I listen to people, gold's bubble has burst. Gold's bubble has burst. Oh, there, I told you. No, and absolutely no. There is no gold bubble at all. There is a bloody debt and fiat proliferation bubble of astronomical mega scale that hasn't even begun to burst, but has wobbled a few times and got the BIS crapping the bed and talking to the Fed, and then suddenly the Fed announcing, yeah, that Cayman Islands actually got 4 times more of our over-proliferated, non-pristine, lost 55% garbage that we crap out at a rate of 1 trillion every goddamn 2 months. That's the truth. That's the facts. That's what gets said. Everything else is linguistic gymnastics of an absolute deception and fraud that you have to cull. They program you with the language they use. There is nothing pristine about the overly proliferated debt assets that are being put out there. And let's hear a little more about this as I rant on with fervor. The repo market to borrow cash, which is to purchase additional government securities. Hey, this sounds like a nice Ponzi-onomics. This practice has further evolved into recent years with investments borrowing equal to higher than the market value of the collateral. This sounds like someone giving you a bottomless overdraft. By the way, Japan did this in the 80s and tried it. You know, buy some property, revalue it 10 times, borrow 95% against it, buy some more property, upvalue that 10 times, get a new mortgage. Hey, you've got a cash flow, capital generating machine. Until you have to pay the loan, until the bullshit of the asset prices gets re-rated back down, and suddenly you're so badly bankrupt, a lifetime and multi-generations after you could never pay back the loss in the fake asset values that have been chased up. This is financialization of everything. It is the paper asset valuations of things that don't hold. Your cars, your everything can deflate, your properties can deflate. Affordability is a function of rates and debt and proliferation. Scarcity is a determinant of value. And anything that is over-proliferated cannot be of great value. Anyway, the practice has further evolved in recent years, leading to negative haircuts. That is, you now understand. The cash lender from the market risk in turn. This is all a gold and silver trade, by the way, guys. You're thinking, he's getting kind of technical now with all of this Ponzi-onomics. What's this got to do with a channel that's been so bullish, gold and silver, and saying, hey, you should be doing this? You being told it's a gold bubble. You being told it's the gold top. I'm telling you, until this Ponzi-onomics hits zero, you haven't even seen the gold price the way it ends up being the gold price. In capital preservation era, which is the new epoch since 2020 and the debt market turn core that we made right here. Hedge funds, relative value strategies are highly vulnerable. This is the BIS. You see that? The BIS, the central bank to the central banks. Nobody's reading this stuff. Thankfully, there's some people that are and highlighting the key pages for us. Hedge funds, relative value strategies, the basis trade, are highly vulnerable to adverse shocks in funding, cash or derivative markets, as evidenced by some recent episodes. They are telling you that April was a basis trade wobble. Donald J. Trump, when he started swinging his baseball bat, telling you about how he's going to China 100%, you 100%, I'll just talk my mouth off, I'm a big guy, I'm going to come into the pub swinging and hooking, doesn't matter whether there's some real pro fighters in there and some guys with guns, I'm going to put some people on the deck. Guess what? I'm not scared about our bond market, he later said. Why did he say that? Because somebody told him he needs to zip it, he's breaking the bond market. That's what happened. It was a basis trade wobble. And the assumption that every time the future will come down and you will always have contango in the market and never a moment of backwardization is absolutely a real systemic risk. But don't worry, it'll be such a big problem because they've all borrowed and got so leveraged that it becomes systemic. That means we privatize our gains and we socialize our losses. Remember subprime? You set the precedent, they're busy doing it again. They're busy doing it again. Only this time, you don't have Ukrainian strippers in Vegas with 10 properties and didn't put $1 down on any of them that you can find out about it because you're going to Vegas and you're checking what's going on. You're talking to your mates who's got a portfolio of property and he never had a dime to his name on a ninja loan that's been bot signed off. That has real evidence to you in the retail space. This is in the plumbing of the primary dealers, the repo markets, the money markets, the hedge fund industry, the nod and the wink, the people that are looking after the Goldman Sachs's, the JP Morgans of this world, that are hedge fund owners. You, unless you have a lot of mates in the industry or in investment bankers, are never going to hear about it. And very few people are here to tell you about it. And what went up when all of this went wrong? Gold did 18%. The dollar collapsed. The rate spiked, which is why in systemic risk, you could actually see the rates collapse. And you can't assume, like milkshakers do, that the dollar's going to go up. It didn't. We've already had a microcosm, and that's what the BIS is referring to, April 2025. And they said, as evidenced by some recent episodes, they're calling it an episode. Yeah, it was a bit of a crisis, I would suggest, this time tied to interest rate swap markets. Yeah, swaps on interest rates. Potential deregulation seems to have contributed to the heightened volatility observed in treasury markets, and they specifically state the date. The Bank of International Settlements, the central bank to all central banks, is telling the Fed that your debt markets went out of control. And by the way, the likes of Luongo and Johnson and all of them all told you it was China that attacked the debt markets. Then they said, no, it's Japan who attacked the debt market. Then they said, the Anglo-Dutch, the Europeans did it. Only for the data to later show the greatest sellers came from within the American complex, which would be Cayman Islands, hedge funds based in New York, and everybody else pulling the basis trade. That is right. That wobble was entirely an American affair. An entirely American affair brought about by building a Ponzi that probably led to Madoff ending in jail and is probably the equivalent. This is long-term capital Mark II, but instead of being a private hedge fund on one, it is large amounts of hedge funds that are being allowed because they are maintaining the liquidity of the pristine collateral. Watch the language they use and say bullshit. Nothing needs to have pristine put in front of it if it is clearly obvious and pristine. I only need to say, this is a pristine watch. That is a great. It looks like it. It stands like it. It is salesmanship of garbage that requires the words such as pristine being put in front of everything. So the liquidity is an illusion. The BIS calls it a liquidity illusion. Assets deemed perfectly liquid. We have said on this channel countless times, it's so refreshing to find somebody else who is saying some of the things that we are saying. I've said, you go try, sell billions, never mind trillions of bonds, 100 billions of bonds. You go there. China has a terminal because they were such big holders and could directly into buy and sell. Now that they ain't buying so much, I don't think the terminal gets used near as much. But when the second largest pension fund in the United States couldn't meet pensions for the Californian teachers' pension and needed to send bonds, they got a call. Hey, is it you with that big number there on the sell, the offer? Hey, man, do you mind taking it down? You're scaring folks. We'll let you lend against it. That's right. That a miracle, that debt upon debt upon debt, pristine collateral, debt, more debt, pink rocks, more pink rocks, debt, and more debt. They said, we'll lend you. They probably would have given them a positive haircut. Hey, we'll lend you more than you have. You want money? Hey, we'll give you plus 10 on top of whatever you have. Don't sell. Whatever you do, don't sell. We are maintaining a Ponzi of market cap valuation in the debt market that cannot be sustained. The debt market is a busted flush. There is absolute, and debt market is the fiat market, which is why all fiats against the gold curve are doing that, particularly the dollar. It is a death knell hegemony dollar story. It is totally degen, as he is highlighting. Oh, and then he mentions the Besant stable coin FUCT Tartary as well. That is not going to do anything. We've been debunking that by scale. It is absolutely minute by comparison. So the Fed is the plumber of last resort, as Joseph Wang was highlighting, in defending the system. But they've made it so big and so large that you can't afford to let it fail. That's right, you're about to have another cost socialized on you by the leverage. The Pharisees of leverage, usury, say it how you want it, borrow here, repo rate there. The fantastical pipelines that they've created is going to get leverage to maintain a failing system. Fiscal dominance and financial engineering, structural repo demand, Fed loses balance sheet autonomy in the end. It is almost assured What happened on the wobble, the mere wobble that rocked the world as that big mouth fool was jabbering on the Zionist pig about raising tariffs? What actually happened? His entire currency collapsed, his bond market collapsed, his rate spiked, and gold ran 18% in 4 or 5 days. That's what happened. That's what happened on a wobble that the Bank of International Settlements are now raising a weary eye and sending a memo over to America. Hey, you know, nice little leverage Ponzi you got going there. You might just want to take a little bit of winding it back. The risk-free, the core irony, the risk-free, someone else is finally calling it out, amplified by regulatory arbitrage and negative haircuts. Hey, borrow more than you actually own, has become a source of systemic instability. That means the entire system is going to fail on account of your conduct. You're letting people borrow more than they own, and they only put up $1 or $2 to buy it, and they got the rest, the other 98%, from the repo market to borrow that they bought. They're rolling the debt on a day-to-day basis, hoping that they make a profit on the shortening of the future in a normal backwardization market that will cover the costs of that daily repo rolling debt until the next 60-day expiry comes along, and that they can make a small yield on their small, real, by comparison, capital inverted pyramid in their hedge fund. That is it. The entire system is being risked by people that are gambling your financial future, your currency's buying power, because everything gets destroyed on any bailout on something of this great scale. They are betting your property and your farm, and they aren't the owners, because to fix it, they're all going to come for your land. That's how it works, friends. What happened in April? There was a real dislocation and repo stress in April 2025. The repo rate spiked, and SOFR and tripartite, it mentions the SOFR rate as well. The UST cash futures basis blew out, one of its wildest dislocations. So what happens is when you get a really crowded trade that everybody's doing with massive leverage, is the opposite starts to happen. It's kind of like we're on a semi-small rowing boat, a little bit larger than a standard tube rowing boat, let's say. We've got about a 20-man boat, but we all run to one side and lean over the side of the boat on the one side. What that does is the boat tips and half of us fall into the water, and once that happens, it rocks back. Balance always gets reasserted. When you have too much of a one-sided thing, the market acts in the opposite direction and flushes them out. If you get backwardization in the futures markets on treasuries, and the cash values of the treasuries go down and the futures blow out to the upside, that you get a widening, every hedge fund with this trade is not only bust, but they bust the repo markets and the money markets too. And those that put their money in the money markets to be safe, like Warren Buffett, suddenly end up saying, hey, you can't let us lose our money. And the Fed shows up and prints a couple of $100 trillion to save the financial plumbing of the entire banking system, repo markets and money markets. And you watch gold, 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 moon, moon, moon. That is the break. That is the break, because all fiat becomes worthless on the scale of Ponzi that is applying here. All fiat will become margin call. You remember the movie? The real issue, fiscal dominance meets shadow banking fragility. And yes, it's in the shadows. That's why you aren't hearing about it. That's why this is capturing my interest. And this is also the reason why you should be aware that the banks are not safe places for your money. You knew that already. You knew that from this channel. The repo markets are anytime able to suddenly go into chronic liquidity shortage, because hedge funds are leveraged buying at 100x treasuries on the basis of making a minuscule profit that they've levered up so much that it actually works out to a semi-decent return for all their investors, and they will be too big to fail by implicit scale. They encourage other people into the trade to make it so vast, so large, you cannot lose. The whole system goes down. That is where we are. It's subprime all over again, friend. Enter Scott Bessent. So many people think Scott Bessent, such a genius. He's worked this out. You know, the goat guys, you know, the cigars and goat guys, they're very into, you know, Scott. No, he's doing a double. Scott Bessent's doing a double cheat on George Soros. He's out to break George Soros, the MI6 agent, we get told. This is their conspiracy, I dare say. And, you know, even though George Soros funded him and helped him become a hedge fund manager, and now he's worth a whole bunch of money, and he worked for him and all of this, he's doing a dirty deed on Soros. Him and Trump are saving America. You voted right. I mean, it's brilliant. You can just sit in your ass and inertia your way out of this. It's all good. You put the right guys in there. The cacocracy Trump, who's front-running every Palantir contract award, him and all the politicians, running shorts on liquidation dumps in the crypto market and enriching himself with all the fellow Zionists like Schwab and all of them standing around. And he made $1 billion today. Yeah, I bet he did. Insider trading to God and love, and they're absolutely destroying the American people, and they are making all the profits out of this. No, you voted right. He's actually working for you. He's just getting a little bit rich first, you know. You know, Rockefeller, the guy that was David Rockefeller, chairman of Chase Bank, that carried Trump through the entire S&L crisis, never called his loan in, let him drive fancy cars, live the high life. He was bankrupt, bust, and then he got a apprentice show and everything, was kept in the media and was this occasional appearance on Oprah and all the groomed. But no, he's turned on them. He's working for you now. Isn't that great? His whole life he owes to Rockefeller. But no, he's fighting the Anglo-Dutch over there. These clowns, these absolute clowns that talk absolute crap, are captured, controlled opposition, are funded by Zios, Mossad, and all of them. That's the only thing I conclude. Or they're just unbelievably stupid. But there are a bunch of them, and you should watch out. They're out there. They are captured. They are telling such fibs. And this man is bringing it as it is. A prominent US hedge fund manager, Key Square Group, by the way, being put forward for next Fed chairman. I wonder where Jay's going. Is he going to the Cayman Islands, maybe? Who knows? Trump says he likes Bessent. He's going to put him forward for Fed. A US hedge fund, a Key Square Group, former Soros lieutenant, but he hates him now. He's going to betray him to protect you because he's an MI6 agent. And vocal advocate for fiscal monetary fusion in the US, publicly supports Argentina's current economic experiment under Milei. So we'll buy their peso because we get a high yield. That's interesting. Zimbabwe's bonds have a high yield. Venezuela's bonds have a high yield. What's your capital value left in a week's time, if you still have any? Yeah, high yield. This is not the era of yield. This is the era of capital preservation. It is not the return on capital, it's the return of capital. Gold is where you should be. This whole Ponzi-onomics has not even begun to unravel, and every time you get a leg and a wobble, gold will be the biggest beneficiary, along in the end with silver and platinum as well. So there is your update from yours truly. But it is a sad, sad story, friends. It is a sad, sad story of Ponzi-onomics, and rates go up, and they're already quite low. They've been coming down for a long, long time. And the Feds had to disclose things because the Bank of International Settlements is looking at them a little too close. So now you know, There is no solid demand. There is captured proxies, as we have always asserted into the face of the likes of milkshakers, Gammon, and everyone else wobbling on about pristine collateral and shortage of treasuries. You're being told absolute fibs to your face, and you shouldn't stand for it. I'm here to tell you about common sense. I'm here to tell you about real foundational money, and that you haven't made a top on gold. You're having a pullback on gold, and it is on a way to a significantly higher number. So much so significantly, you're not even ready to believe it. So with that, let's fill in these numbers again of how far it's pulled back, and all these pullbacks all the way along. You had a 9% pullback back then. You've had quite a few. You had a 10.84. This one must be around 11 or 12%. Let's measure it together. To its current level, no, but to its lowest level, it might be low teens. Let's measure. Measure with me. High point, gold. To the absolute lowest point, 10.26 to its lowest point so far. To its current point, 8.6. 8.6. So let's go 10.26. Let's get that written in. Current low, it might need adjusting. We're not saying it's over yet. 10.26. But it's a top. Well, I ask you, was the last 10% a top? Was this a top? You got a setup for a major move. We told you about coming on this channel from 3,350 that ripped you $1,000. $1,000. And I mean ripped you big time. How fast did we go? Let's do the $1,000 test. How long did it take us to get to $1,000 the first time? Now I need to switch the lights off. We need to go big time frame here. This is the history of gold. This is the history of gold. Look at that chart. I mean, can you ever? I mean, can you ever? When did we cross $1,000? I believe it was somewhere there. The high, what was the high? 1,032. From the very beginning of the existence in time of the dollar gold mechanism, which takes you back to the 1800s, to 2008. So I would say it's safely over 200 years. Agree with me? 200 years to get to 1,000. Now, how long did it take to get to 2,000? So you went from 08, boom, 2011, that's actually, my apologies, 2020. So 12 years. So you've gone from around 200, 250 years to 12 years for the second 2,000. You see, you made 2,075. So 250 plus 12. How long did it take from this call, by the way, also made on this channel for trading gold with you once, twice, 3 times, then the lady. Remember that? You do. You know you do, and I do. 2,000, told you, 3 grand comes next. So with that departure, you made 2,000 in 2020. When did we make 3,000? When did we cross the 3,000 mark? That was 3,000 in that candle right there. 2025. So you went from 250 to over 12 years to the next one coming virtually with less than 5. And then, how long did it take from 3,000 to make 4,000? Now, I would suggest we drop to the monthly time frame. 3,000, you were roughly, where was it again? Let's go. There's 3,000. High was 3,000. From March 2025 to October. March to October, your next 1,000. So you went, how many months is that? 3, probably 3 the other way. It's about 6 months. So we went 250, 12, 5, 6 months. Do you spot anything in that trend? Do you spot anything in that trend? I do. I do believe I do. I do believe that this thing is accelerating somewhat. 250, 12, 5, 6 months. It's accelerating. Each 1,000 is coming quicker and faster. Can you wait another 6 months, maybe? Can you? Could you? For 5,000 and something, because we're not on the nose 4,000, we've gotten higher. 5,000. Can you give us 6 months at least? I think you will. I think you can. I hope you will. I hope you can. I should be sharing the chart. That would have been so much more useful. So let's put it back on and show you all of that, just so that you can see the numbers one more time. There's the beginning of time that takes you to 1,800. The 1,000 was cleared there. I don't care how far you go back. I'm happy to go 250 years to potentially the beginning of time on the dollar system, but let's have a value. There's 1833 to 2008, 1883. 200 years is 1980 is 100 years. Yeah, so it's maybe not 200 years. It's a little bit less, but who cares? It's an immense amount of time. It's somewhere between, I don't even care to do the math. 2008, 1883. 100 will be 1983 plus another 20. About 120 years, then you drop to 12 years to here. So from 2008, you were here. And you just did the 2000 the first time. It turned out a continuation. You just did it, but we counted it. So there's your 1,000, there's your 2,000. When did your 3,000 come? Your 3,000 came there. Where did your 4,000 come? Your 4,000 came there. So this goes 120 years to the left, goes 12 years to the right. You then ended in a 3-year sideways move that goes 5 years for the next 1,000. That goes 6 months for the next 1,000. 6 months. 6 months. 120, 12, 5, 6 months. Hopefully we showed you the chart this time. Apologies for that. So what do you think? You think it's a top? You think it's a top because it's a parabola? You haven't seen a parabola. When that debt Ponzi system is over, that will be the end. When the debt system is over, that gold price will be the end. When the gold-silver ratio, friends, XAU, XAG, you haven't even had yet the market. We warned that the gold silver ratio could go back up. Everyone was, it's going to be one way down. No, you've got a hammer here now. Gold is doing a little bit better, silver's selling off a little bit more, but not forever, not forever. We said to you, once, twice, 3 times a lady, we said at the $50 mark, you should get a rejection again, and it's the next one when you rip. The news is brilliant. It's not bad, it's brilliant. And you got rejected, you made $53.50, a little bit higher than I thought it would be. I thought it would be somewhere in the mid-40s to the 50. But of course, there's been a bit of inflation and a little bit of creeping up, a little bit of slipping out. The dollar's not the same dollar it was in 1980 or 2011. We'll show you that chart next. But you got a hammer, you get a little bit of a rally back. You've been stuck in this range. It gets interesting for silver. This guy that I can barely pick up, this guy, it gets interesting. How many of these do you have? How many do you have? Beautiful. Hit a man on the head with this. He ain't getting up. How many do you have? How ready are you for the great silver mega run? And, for the little kids in your life, they can hold that one up. That is 10 beautiful ounces, I believe it is. 10 beautiful ounces. It also trusts in God with a lion's head. You can hold those and you can be absolutely strong. I think this goes back into range a little bit and breaks. The next time, I think we do break out. As it's hammering, I think it goes up a little bit, but then the next move is out. We will always say the only thing that changes that is that basis trade goes up. Then we have the hugest bailout, which I think is almost a certainty at some point. But if it happens short term, then gold is going to be the main runner again, which will explain to you how early we are in this trade. I've said on this channel a couple of times, people got too heavy silver investments initially. Gold runs first. You could get, if that DDE, you could get gold dominate again for a bit. You might even get that, we warned, possible spike. Remember, possible means it's being underpriced. It doesn't mean it's our base case scenario. So many guys said, you said 170 ounces, 170 gold silver ratio. We said, no, we didn't say it. We said it's underpriced as a possibility that can occur. And you could get a rally, and it could still occur if you get a demand-destroying event. And I've just explained one of the biggest Ponzi's that could indeed be a demand-destroying event. And where does the rich money go? Where do the central bankers go? They don't buy silver, they buy gold. That's what will cause a spike in the gold-silver ratio. But notwithstanding if there's no demand-destroying event, in the end, the next move up for silver will be the winner. And let's go have a look at that silver chart. Let's go do it. You want to see it. You've got to understand. An underpricing could mean most people think it's impossible. It's not even being priced to 0.1%. And I think it should be 15%. That doesn't mean it's definitely happening. It just means it's well underpriced. Here's the shooting star. Many people will say, yep, super bearish. You can have a shooting star, you can have a small dip further for a while. This could be over also pretty quickly, it depends. That typically is a reversal, but that's the month, and we've got 2 days left. I don't think it changes, but it's not a guaranteed reversal. You might dip slightly and you can run. There are many instances where you get a shooting star and you come up again. You see there, you got a shooting star, you ended up trading back up there. In the end, you sold off a little bit, but it's not 100% proof that you have to only sell off. I think it'll ease for a while, but I think this was the rejection we wanted. This was the rejection we wanted. It's the rejection we ordered on once, twice, 3 times a lady. It's your 3rd time. And guess what? As we said repeatedly on this channel, we showed up with Mario. Mario said it's just going to run. He doesn't see a pullback at that time. We said, no, we think one more time you get a pullback, even though it was already into the 50s there. There's a little bit of inflation. This is a bit higher than that one, and this is higher still. There was a real squeeze. Lease rates were running, but they're going to put the genie back in the bottle for a spell, but this is your trade. This is your trade. And for HVF traders, which will help you do an accelerated stacking of precious metals like what we are doing with really safe, non-politically exposed vaulting services and all forms of other things, hit the link below to find out how we do turbocharged stacking by leverage trading only to the long side at key moments, not doing anything at the moment in terms of gold and silver right now for obvious reasons. But other markets are providing opportunities potentially. So this is the HVF draw that we will show you on the silver market and remind you as to why we say once this breaks, it's going to pull back now. Once it breaks for the second, well, it'll be the 4th time, 3 times, and then a lady, it's going to be the lady's turn. That's when it runs and runs and runs. And the first pause will probably be in and around the 90s level just before going 3 digits. Why? Because HVF method says so. And it is incredibly reliable. And it is geometrically produced by the very same markets that we are watching. Let's just see what the high is there, that I'm typing it correctly. 49,81428. That would be right. 49,81428. There you go, right in the correct number, and things work out a whole bunch better. Let's see what we get. So this is the draw that on target will be making 333. Yes, I added the extra $3 for dramatic effect for the Freemasons in the audience. I hope there's not too many actually. 49,81428. What am I doing wrong? What am I doing wrong? Why is it not doing my draw yet? 49,81428. Yeah, that's pretty much right. Let's make sure that nothing else is interfering with it. Yeah, take out the 8, put it back in. Sometimes it takes a second or 2 before it redraws. Okay, punk, stop with your shit. Tools, tools, and tools. Can also be a failure to reset. Let's refresh the site. Come on, come on, come on, come on, come on. So what do you guys think? Who thinks it's a top? It's a localized high, maybe for a short period. Much more than that, I will not grant you. What do you guys think in the comments? I'm going to refer to your comments now in a second. Let's get this tool loaded up. It's been a bit sketchy. Come on, man. Come on. Refresh. Sorry about this, guys. Internetium. Don't want to play so good. TradingView doesn't want to refresh for a tool. Thank you, finally. And now that change. So we've got a slight imperfection. It's because of inflation and the duration. We put in the 49.81428 that we want to exclude as a high. It's a wick high that's marginally higher. Finally, we get what we want, and this is why you are in a break. So to be clear, HVF method got you into this long before the cup and handle guys. The cup and handle guys. The right framing for this is an upside HVF. of ascending structure with likely overperformance, which would mean you wouldn't do 100% close at target. And that is your target, 331 you're getting on this particular broker platform. It will be 333 on other ones. What has just happened? You ran your first interim target, so you get a pullback. There's your shooting star pullback. Maybe you'll support on the first interim, which is 49.28. Maybe you'll have a deeper sell-off. There's a possible head and shoulders for a deeper sell-off. I don't think it will happen, but you could legitimately, you could come all the way back to 30, and it is just a return move. I don't think that happens, but it's possible. It depends. Demand destroying event, chaos. Everybody's money gets deflated, debt, bailouts for bankers. If you have enough drama, it's quite possible that you could get back there. But the next move, when you come back, the fourth time, the lady, 1, 2, and of course 3, and you end up with a run that will take you to the 330. Okay, let me get the screen back. Sorry about that, guys. Let's show you that it finally came up. Apologies. It is so easy to not see. You can't see. You see and nobody else will see. So once there's the high, 2 again, and then you come back up a little bit of a shooting star. You could come back, as I was saying, even to the return move. That would be right down to $30. I don't think that's happening. It's not my base case. Don't say you said it's going down to $30. I'm not saying that. This is possibilities and probabilities. It could do that and still be entirely compliant with the upside HVF structure that we have as a draw, which would see us then, whatever it does as pullback, which will be a lot smaller than all of these. You've just seen it go from thousands, 120 years, 12 years, 5 years, 6 months. That's what's happening here. In the same way, the high 1 to the high 2 spans 1980 to 2011. You're talking about 31 years. Then the second high to the current high that you are in, you are talking about a much lower time frame, 2011 to 2025. So that is about 40 years down from 31. Could you pull back for a spell? Yes, you could. How long? It's not really that important. You must use the opportunity to stack the next eventuality, as we suspect is the rest at just before the $100 run, the 3 digits, which will be resisted because it will be very newsy event. And then once it's been allowed at the 3 digits, the rip to the 333 and beyond will be violent. So these moves, after whatever pullback silver is making, once it goes again, will be violent. It will be violent, however low it goes. Do you want me to look at the lower time frames to see how low might we go? What could be the worst case scenario? Again, not my base case. How bad is it? You're getting a small time frame hammer here. By the way, after that sell-off, which is a little bit bottom picky, it's already not that bad. With a hammer, but there were some things. You had a head and shoulder. We drew it inside our community. We drew that for you. Yeah, you had a head and shoulder. That was it, and it made the target. Bang. You also have a smaller time frame pattern, an inverted HVF structure. That's right. With our draw tool, you would know that that was there as well. Let's draw that one for you. There it is. You made that downside sell. It gave you a boost. You see it? Look how beautifully that exited you. Do we short? Not interested in shorting. We're not interested in shorting. There's your triggering event. There's your rest at the first interim. Look how many candles. Kettle, drumsticks, range testing. Little bit looks like a hammer, looks like a shooting star. And then spiller, absolute thriller. Capitulation phase, target made, rally, chop and churn. Little bit of resistance. Where's the resistance? At the second interim target of 47. Fancy that. All coincidences, I assure you. Not the greatness of HVF method. Beautiful exit there to get out on the longs after that sell. This was a broadening structure and was highlighting higher volatility. It was highlighting higher volatility. Look at it. You can see it there. Drawn. Broadening structure. Ascending broadening structure. You're going to get some bearish action. Out on the splitter of the broadening structure in a bear flag. Warning, drew this bear flag target made after target, wind up, small time frame inverted HVF, delivers the head and shoulder target and a small boosted target to make more. That's it. That's what it does. How does it go for another selling leg and we be wrong? Remember, you've got that monthly shooting star. It can still go a little bit wrong. The worst outcome, and again, not my primary base case, but a possible one. That means a lower percentage than what I think is my primary base case, is you've now made the 46 on both sides. This would be the worst case scenario, as I say. That would be a left shoulder then. It's a bit small for a shoulder. That would be down, and you'd need some form of a rally to give you some form of a right shoulder, and then you'd have a neckline there. So if you get a soft rally that then comes very hard back down to the 46 level, that could be a warning. You could get a double bottom first, and that could rally off that. But if you break the 46 and make a new low, that could be a potential sign that this head and shoulder is going to go deeper. If it's going deeper, how far does it go to the downside? Many will say, shock, horror, it's not allowed to go down. Once it's gone up a certain amount, they think it's ground that you've covered, you can never go revisit. Well, this could be a sign of Cayman Island, Basis Hedge Fund, some other crisis, and gold could be relatively overperforming. That guy who told you that, listen, the gold-silver ratio can also go up if you get a demand-destroying event, might suddenly not look so stupid. Back down, you would be 2 hourly. It should not be log scale. I think it is. So reg, let's do that again. How far would it go? Potentially, if the head and shoulder triggered, which I am not seeing as base case, because it's going to depend on gold as well. If gold is finding a base, which is looking a little bit better on gold, I would say, then silver can be saved from this being a head and shoulder. So there you go. That would be around 37.7. I will only take that seriously if we get a vicious break through 46 with momentum that runs that low. Then you need to start thinking it might be on. And again, back up the truck, be ready to buy more silver were that to happen. Not that likely for me. XAU, and at some point you can just stop making downside targets. The XAU also had a little inverted, it pushed you through. Now what I like about this is it actually traded, and I was telling the community this morning that this traded quite some way below this. So this didn't serve as support. It reduces it from being a head and shoulder for gold. Gold had a double top, where silver had a head and shoulder, perfect exit there on a wick, and then you've got an inverted structure here. In fact, we can move that structure slightly. There's a bigger target to be had, which was also made, and it was there. There's the inverted draw. Gives you a tiny bit better draw. That's where your target, you made that. It spoiled the head and shoulders a bit because this is very low, and it's unlikely to be a neckline. Necklines must be very close to horizontal, the key levels, 3,950. Of course, 4,000, the key level. We just made that 4,000. We did it in less than 6 months. That's right, we did it in less than 6 months, from the 3,000 to the 4,000. And in fact, we traded 4,350. So for me, no leverage trading action, great time. Remember, for me, non-advisory, I'm talking about myself here. But great time to be dollar cost averaging, great time to be accumulating in blue pot, non-leveraged investment. For me, that's what I'm doing. These are some of our new stacks. Ooh, beautiful, beautiful, beautiful. The other one, it's almost too heavy now. I'm tiring. Let's have a look at some of your comments and what you said. Let's try, if we do share screen, remember it and be better. So how are you guys doing? 928, 426 likes. We greatly appreciate you for checking in and giving us the hit-ups on the stream. Don't forget, by the way, the mini-series, the Cayman Islands newsletter that we did, we've actually addended it as well now. And there is clear evidence that there is an absolute hyper-leveraged, Ponzi-ized macro demand creation mechanism for the purchase of treasuries that are all putting the entire system once again at risk at your cost while they privatize the gains. That is what's going down without doubt in my mind. It's the modus operandi of long-term capital, the subprime crash, and everything else that they orchestrate and weaponize against you. And it could see banks in America and the West as a whole go into real problems. Again, this is a problem of the West particularly. Yes, it's going to have knock-on effects to exporter nations like China and everyone else, but it is a huge, huge problem. You need to think about where you want to see this out. You don't have to be in a war-torn country with a tax scavenge mode engaged, which all the governments will and can and are doing. France is looking at a 10-year tax moratorium where they can continue to tax their wealthy that leave the country for 10 years after they've left the country. Imagine that, 10 years after. You haven't done, that's what they want to do. Global tax extraction for nations being discussed and thought about for Australians. Don't wait till they implement it. Get out now. But everyone goes, where do I go? Where do I go? Sometimes leaving the room is as important as to where you go. You can go anywhere that's not the West. You can start anywhere. You need to start building locales where you can stack, a place to live, where you're happy, a peaceful, secure, non-Western jurisdiction. And all these countries are considered below you. You know, you're in the first world and they're below you. We're in Panama. We're in Cyprus. We're in Cyprus on the fringe of Europe, but it's also got northern Cyprus, which is Turkey. We're in South Africa. You can look down on these countries. I have better standard of living in my third world nations than you probably have in your first world nations. Everyone just treats us as lords and gentry, just by virtue of being gold stackers, able to make our bills and having a good existence and on much lower cost basis and pay less to the extractors. How about that? You should all be doing that. Don't fund them. They are weaponized against you. They are here to steal your money in your banks. They keep you running on a treadmill, then they steal your proceeds and give you a pittance for a pension. And they will talk about pristine collateral and risk-free rates. The great lies that they spin and the yarns that they spell. Okay, thanks very much for joining us for today's, I suppose, rant. Watch out for the basis trade. You might be getting the futures headline. When everyone else goes, what's this? We've all had our bank's money stolen. There's a bailout again, something about a basis trade. You will know. You were given the news before the news. The same guy that told you oil's going to go down and gold's going to go up told you that. The same guy that warned you that the USD Korean won is close to triggering and going on a major hardening event. What geopolitical event is going to hit South Korea? The same guy that told you the debt cycle turned in 2020, only for the big names to confirm it in 2024. The same guy is trying to help you save yourself by watching the macro charts, seeing all the obstacles. There is no real journalism out there. There are repeater stations for media-friendly messages that are being cultivated, manufactured, and consent by mealy-mouthed deceivers and deceptionists of great skill that have you believing pristine and gold-lined and copper-bottomed bullshit about their absolute proliferation of fiat. You should reject all this phraseology that is attempting to program your brain with something grand that is absolutely poisonous, as they did for the events of March 2020, absolutely poisonous. We will continue to try bring our version of the only truth that exists, the real truth, the facts of the situation to protect you. We are unfunded by any party. Nobody pays us for any message. These are my opinions that I share that are undiluted, that I come to of my own accord in a pursuit for truth. And what is the real situation? Nobody spins or pays us to direct away from the Zionists and tell you the Anglo-Dutch and tell you that Besant's on your team and Trump's on your team. These people are dangerous. They are probably captured or they're exceedingly insidiously stupid. Be warned, be warned, be warned. Okay, until I catch you next time. Thanks very much for the support. We love you and leave you. And we might have an interesting guest coming to Panama that we'll do a stream with. Many Americans of great consciousness that aren't in the milkshaker Coke category. Look at the demand for our debt. are actually building plans outside of the American jurisdiction. Yes, they are, and they are coming, and they're talking to people who are already there. We're one of the people on the beach here. We have community members here. We have a lot. I have friends here. We can go and talk to fellow snipers. Now other Americans and UK people, Australian, Canadian, not just Americans, are all realizing their government can't tax you by the sleight of hand of inflation anymore. They're going scavenge mode, going direct to source. They're going to squeeze your nuts. They're getting aggressive and totalitarian so that they can say you benefited from the system, this Ponzi system they created that insiders got very rich on. Now they're going to make you pay for it. Do you want that for the remainder of your years on this planet? Do you want it for your children, or are you a leader? Are you inherently stuck in inertia, or do you take action? Go read your media. Tell me if it feels good, all the things they are initiating in bringing about tokenization, bringing about forced taxation, new potential taxes, more immigration, all of which you're paying while you're getting slaughtered in the streets by savages that don't have your culture. You've got to decide, where do you want to live? Where do you want to see it out? It only goes down. We have hit peak west. You have to think the unthinkable. Children cope. Children survive. Children go to school and readjust. Everything is possible. It's time to start having a plan. Even if you just do holidays and have a sniff, start doing something. Have it outside the jurisdictions. We catch you later. Thanks for watching. Bye for now.